Okay, welcome to topic 7. In topic 7.1, we're going to talk about the gross domestic product, and we've talked about this some. This is the value of all goods and services, the final calculation of goods and services that's produced within the United States. So we're going to explain how it's calculated, how we interpret it, any factors that influence GDP, and then other output and income measures that we use to determine how well our economy is doing. So, national income accounting, this is a system that economists use to uh, collect the macroeconomic statistics. And remember, we said macroeconomics is anything on the nation as a whole. Uh, so these statistics that deal with production, income, investment, and savings. The GDP, know this definition. It's the total value of all final goods and services produced in a country in a given year. Intermediate goods, these are products used in the final production. So this would be like all the parts you need to build your finished product. Those are intermediate goods. Goods that are durable, they're going to last for a relatively long time. Refrigerators, stoves, cars, DVD players. Non-durable, it'll be a short period of time. Food, I think of milk. Milk only lasts so long and it goes bad. Eggs, light bulbs are eventually going to go bad. Shoes, you're going to replace those. And then we have different types of GDP. Nominal GDP measures the gross domestic product in current prices. Whatever the current price is, that's our nominal GDP. Now, real GDP is where we express it in constant or unchanging prices. And we're going to go through a scenario so that makes it a little bit easier to understand. But we want to remove inflation and compare prices, have one fixed price for a certain item so that we see, are we producing more or has GDP risen just because of inflation? The GNP, gross national product, this is the annual income earned by a nation's company and people. So the gross domestic product is the final value of all goods and services within the U.S. borders. The gross national product would be income earned by any American company and any American, even if they're overseas. Depreciation. This is the loss of the value of capital equipment that results from normal wear and tear. Example would be, you buy a new coat. If you go to sell it used after some time, you're not going to get full price for it. It depreciates because it's used and it's got wear and tear. Your car, same thing. Brand new car, you drive it off the lot. It's now used. It's got some wear and tear. It's going to depreciate in value. Price level. This is the average of all prices in the economy. Aggregate. When we hear the word aggregate, I always think of a driveway, don't you? Well, and in that driveway, what do you have? It's just a whole lot of stones thrown in there. Not one in particular. It's just a whole lot. So when we talk about aggregate, we're talking, this is a macro term. This is all the supply of everything in the United States. Okay, it's the total amount of goods and services in the economy at all possible price levels. So it's everything. It's the supply of cars, pizza, eggs, anything you can think of. It's the supply of everything, as well as aggregate demand. Aggregate demand, again, a macro term. This is the amount of goods and services that's demanded at all price levels. And again, it's anything that we demand. That's where aggregate comes in. You throw it all in, everything. So how much do you pay attention to the news? You probably don't, unless it just pops up on your phone. You probably have heard things like GDP, GNP, NNP, NI, DPI, and you're like, okay, are they texting, whatever? You probably haven't thought much of it. So let's look at GDP. What exactly is it? GDP is the dollar value of all final goods and services produced within a country's borders. So we're talking about within the United States of America. It includes, okay, the cash value of all goods and services sold, but we do not take into account the cost of producing it. We want the highest price. Like if you're producing an iPhone, we don't want all the intermediate levels of what it costs. We want the final price you're selling it to the customer because that's the most expensive price. In the yellow, it's goods and services that are offered to consumers. We don't want intermediate goods that are used. So if you go wholesale and if I buy a t-shirt wholesale and I put a monogram on it, we're not going to count those prices. We're going to wait till I sell it to a consumer, and then that's the price that we'll record. And then it's also produced within a country's borders. They're in the green. It's any company producing in the United States. So even if it's Nissan, that's a foreign company, we're counting their production. We do not count any U.S. companies producing overseas. So if somebody is offshoring and they've got a plant in China, we are not counting what they're producing. We're not. So here's our gross domestic product spending by category. If you look, 32% is spent on housing. That makes a lot of sense because that's usually people's biggest purchase in their life. 18% is going to be on transportation. Car would be your second biggest. And then you've got food, 13%. You got 22% there, which is just other stuff. 4% for clothing. So this kind of shows, this is an average of how we spend across the United States. Mm-hmm. Here's the iPhone example I was telling you about. These are all the parts and things that need to be made and bought and put together to create an iPhone. And it's funny, did you look? It's an iPhone 3G. 3G, yeah, that's how old this is. I didn't even have a 3G. I didn't even get an iPhone until it was a 4. It was little bitty. We don't count the intermediate goods. We only count this final one right here where this price, where we sell it. This goes to the consumer. All of this stuff just is intermediate. They go together. They get put together to create this iPhone. That's the value that we add to GDP. So there are 2 GDP measures. We talked about it. You've got nominal, which is in real-time dollars, exactly what it costs today. And real is where we adjust for inflation so that we are comparing. If we're selling a truck, it's going to have the same value each year that we are looking at it, so we can see how much we have increased or decreased production. So how are we going to calculate nominal GDP versus real? Here's a great example of it. Okay, this is nominal. We have a base year, and this base year here will be true for nominal and real. Both of them have to have a base year. And it will always be, even when it's real GDP, the first year will be in nominal dollars because we're valuing it at the dollars for that year. So this year we've got 10 cars at $15,000 each, 10 cars at $20,000 each. So this is the price we've got here, what I'm underlining, for a car and for a truck. Multiply, we get nominal GDP for year 1 is $350,000. Now, when we get to year 2, we can calculate a nominal and a real. Now, nominal is in current dollars. So if you look, the price of the cars have gone up $1,000. So have the price of the trucks. So when we do our calculation, you can see it was $350,000. Now it's $444,000. That looks like we went up $94,000. But did we really increase production by that? We have inflation in here. And there's actually about, $24,000 in inflation? So this is where we're going to calculate this real GDP. We take the actual number of cars and trucks that were produced this year, but we value them at the nominal year prices. And so you can see now we're comparing apples to apples price-wise. our GDP did go up by about $70,000. We did produce more goods and services because we valued them at the same price. GDP is a great tool. It's one of our leading indicators to see how the economy is doing. But just like anything, there's not one that is, the magic carpet or anything like that. It doesn't take into account certain activities, certain aspects of life, the underground economy, negative externalities, and it definitely doesn't take into account quality of life. Professional daycare services are included in GDP. However, unpaid child care, so a stay-at-home parent, that's not calculated. Or if you're babysitting, you get paid cash. It's the underground economy. Those are not included. So as you've read, we've got national income and product accounts. There's so many different measurements to help us judge the performance of our nation's economy. And again, when you look at it all as a whole and you look at each one, it helps give a bigger picture of how the economy is doing. Most of these yardsticks, though, are derived from GDP. And so we're going to look at 5 other indicators that all come from GDP. You've got the gross national product, the net national product, national income, NI, personal income, and disposable personal income. So gross national product, again, this is where we are going to subtract out from the gross domestic product any foreign companies and non-U.S. citizens. And then we're going to add in any income by offshoring U.S. firms and citizens living abroad or in another country. The net national product is where we're going to take the GNP and account for depreciation. So any equipment that's there, we're going to depreciate that. The net national product will be that GNP with a few minor statistical adjustments. And then when you take the net national income and you take out income taxes, just like in your paycheck, we take out the income taxes, the Social Security and Medicare, add in any other household income. That is the personal income that people make. And then when you subtract individual income taxes, that's disposable personal income, or basically the amount of money we get with our paychecks that we can spend. Because how much money you make versus your take-home pay are 2 different things. That take-home is disposable personal income. You can actually spend it. If you had a laundromat here, you would have to depreciate for the washers and dryers. They're not going to last you forever. So if one of these cost you, say, their commercial $5,000 and it lasted over 10 years, that was the estimated life, you would depreciate this equipment $500 a year over 10 years to get $5,000. So we've talked about GDP, what it is, how to calculate it, and then we've got limitations. It doesn't account for underground economy, things like that. But if we want a strong GDP, we need to know things that can make it go up or down. What are influencers? Okay, this is what macroeconomists study. They want to know how we can influence GDP in a positive way and what things are going to influence it in a negative way to see if we can keep that from happening. And there are 3 things that can affect it. We've got aggregate supply, aggregate demand, and then the equilibrium point of aggregate supply and demand. And again, aggregate supply is the supply of everything in the country. Aggregate demand, the supply of the demand of everything in the country. And then that equilibrium is just where supply and demand curves intersect. It's where supply equals demand. So here we've got aggregate supply, total amount of goods and services available in the economy, everything available for purchase to consumers. Now, this is our aggregate supply curve. And we haven't gone over this yet just because I've pushed topic 3 back about supply and demand so we can be in class, hopefully. But a supply curve is always going to be upward sloping. It can be a straight line, it can be curved up. It's never going to be like this. It's never going to look like a humpback whale. Okay. It will always either be straight line or some type of curve. Now, the AS stands for aggregate supply. So if you ever see this on a graph, you know this is macroeconomics. It's aggregate. It's the supply of everything. It's nothing in particular. So here we have price level and real GDP. Okay, so the positive slope means that as price level goes up, GDP, real GDP goes up. And that is 7-1. Happy studying.